Welcome to part 11 of the Stock Trading Ninja series, Backtesting and Probability. I'm your instructor, Frank Bunn, and in this segment I'm going to show you how to properly backtest a system to determine probability so you can begin to get comfortable with your ninja trading skills. Let's look at our objectives here. The focus of backtesting is primarily to gauge system efficacy. Bottom line, we want to see how well it has functioned in the past had we traded signals in real time. But we also have an opportunity to test contextual variation and see how different setups performed within different long-term trend contexts. This is some good information to have, and it's how I stumbled upon the EMA fan strength of trend indicator. Next, we can get an opportunity to hone our pattern recognition skills, which is always helpful. And finally, we want to remember that our goal and objective is empirical analysis and testing. We are not looking for some indication of future performance, because we can never forget the rule of randomness. So with all this in mind, let's examine the specific procedure for backtesting. First, we determine the system for universal triggers. Next, we determine the interval time frame, whether it be daily, weekly, or an intraday interval. Next, we determine and list the proper technical filters we want to use. Optionally, we can determine the specific price patterns that we learned in video number 5. Next, we determine our trade management model. After this, we calculate risk assumed on each entry plus our targets. And finally, we document wins, losses, and cumulative R using our samples. This will give you a solid foundation for objectively, and I mean objectively, analyzing historical samples. You will also be analyzing apples and apples, which is important given constantly changing contexts. Here's a recent backtest of 4 trades in Apple Computer during a 10-month period from January to October. Using the 3-6-18 system, there were 4 triggers as you can see listed, resulting in a sum total of about 100 points in profit versus a similar loss for the buy and hold investor. Let's take a look at the actual trades. Here's the first trade, a short, followed by the second, which I really didn't like as much intuitively since the 18 breakout had already occurred previously. Interestingly enough, it was the poorest performing signal. Followed by this signal, a classic breakout with the long-term trend underneath it. And finally, this last setup during the autumn correction, another classic 3-6-18 breakout. It is important to remember that I did not curve fit this data or manipulate the backtest procedure in any way. Those are the 4 consecutive trades randomly generated in that time and data series during the period specified. Use this procedure as your primary method for backtesting any system. You'll find it will give you all the information you need to objectively gauge system efficacy and begin to integrate the key principles which will make you a great mechanical intuitive trader. And I'll see you in the next installment as we begin to wrap up the training.